Hey there, welcome back to AQ Finance. Today, we've got a captivating topic lined up that's sure to captivate your interest. Whether you're a novice in the realm of cryptocurrency or a seasoned trader, you've landed in the perfect spot. In this video, we're delving deep into the intricate world of future trading versus spot trading, offering valuable insights to empower your investment decisions. But before we delve into the details, I'd like to extend a warm invitation to support our channel by hitting the thumbs up button and subscribing. Your engagement fuels our passion for creating informative content. Moreover, we cherish your feedback, so don't hesitate to share your thoughts and queries in the comments section below. Without further delay, let's embark on this exhilarating journey together. Today, we're going to tackle an essential aspect of cryptocurrency trading: the difference between future trading and spot trading. Future trading involves agreements to buy or sell an asset at a specified price on a future date, while spot trading involves buying or selling assets at the current market price for immediate settlement. Understanding the nuances of each approach is crucial for making informed investment decisions in the volatile world of cryptocurrency. The key distinction between future trading and spot trading lies in the timing of the transactions. In future trading, investors agree to buy or sell assets at a predetermined price on a future date, regardless of the current market price. This allows traders to hedge against potential price fluctuations and lock in profits or mitigate losses. On the other hand, spot trading involves buying or selling assets at the current market price, with transactions settled immediately. This provides traders with instant liquidity but exposes them to the risks of price volatility. Spot trading, also known as immediate or cash trading, is a straightforward method of buying or selling assets at the current market price. Unlike futures trading, spot trading involves transactions settled instantly, with assets delivered immediately upon purchase. This approach provides traders with quick access to liquidity and allows them to capitalize on short-term market movements. Let's now explore the pros and cons of spot trading. Pros of spot trading: instant execution. Spot trading enables transactions to be executed immediately, providing traders with instant access to liquidity. Simplicity: it's relatively simple and easy to understand, making it suitable for beginners in the cryptocurrency market. Flexibility: traders have the flexibility to enter and exit positions quickly, allowing them to react promptly to market changes. Reduced counterparty risk: spot trading eliminates the risk of default associated with futures contracts, as transactions are settled immediately. Lower costs: spot trading often involves lower fees and costs compared to futures trading, contributing to higher potential profits. No margin requirements: traders do not need to maintain margin requirements in spot trading, reducing the risk of margin calls and liquidations. Cons of spot trading: price volatility. Traders may be exposed to price volatility, as spot prices can fluctuate rapidly in response to market dynamics. Limited risk management: spot trading offers limited risk management tools compared to futures trading, making it challenging to hedge against adverse price movements. Lack of leverage: spot trading typically doesn't offer leverage, which may limit potential returns for traders seeking amplified gains. Higher market entry barrier: engaging in spot trading may require a higher initial investment compared to futures trading due to the need to purchase assets outright. No time hedging: spot trading doesn't allow traders to hedge against future price movements, as transactions are settled immediately. Futures trading is a sophisticated financial instrument that involves agreements to buy or sell assets at a predetermined price on a future date. Unlike spot trading, futures trading allows traders to speculate on the future price movements of assets without owning them outright, while futures trading offers the potential for significant profits. It also carries a high level of risk due to its leveraged nature and exposure to market fluctuations. Let's delve deeper into the pros and cons of futures trading, highlighting both the potential rewards and the inherent risks involved. Pros of futures trading: leverage. Futures contracts allow traders to control a larger position with a smaller initial investment, magnifying potential returns. Risk management. Futures trading provides advanced risk management tools such as stop-loss orders and limit orders, allowing traders to mitigate losses and protect their investments. Price discovery. Futures markets facilitate price discovery by providing transparent and efficient platforms for buyers and sellers to interact, leading to more accurate pricing of assets. Portfolio diversification. Futures trading offers opportunities to diversify investment portfolios beyond traditional asset classes, potentially reducing overall portfolio risk. Speculative opportunities. Futures markets offer ample opportunities for speculation and profit-making, especially in volatile market conditions. Cons of futures trading: high risk. Futures trading involves significant risks, including the potential for substantial losses exceeding initial investments due to leverage and market volatility. Leverage amplifies losses. While leverage can magnify gains, it can also amplify losses, leading to rapid and significant erosion of capital if trades move against the trader's position. Margin calls. Futures trading requires maintaining margin accounts, and margin calls can occur if account balances fall below required levels, leading to forced liquidation of positions. Lack of liquidity. Futures markets may experience periods of illiquidity, especially in less traded contracts or during volatile market conditions, which can hinder the ability to enter or exit positions at desired prices. Market manipulation. Futures markets are susceptible to manipulation and speculative attacks, leading to artificial price fluctuations and increased market uncertainty. Complexity. Futures trading requires a deep understanding of market dynamics, risk management strategies, and regulatory frameworks, making it unsuitable for inexperienced traders. Why spot trading may be better than futures trading: lower risk exposure. Spot trading typically involves lower risk compared to futures trading, as transactions are settled immediately, reducing the impact of price fluctuations and margin calls. Simplicity and accessibility. Spot trading is more accessible and easier to understand, making it suitable for beginners and casual traders who may find futures trading too complex. No margin requirements. Spot trading eliminates the need for maintaining margin accounts and the risk of margin calls, providing traders with peace of mind and greater control over their investments. Cost effectiveness. Spot trading often involves lower fees and costs compared to futures trading, contributing to higher potential profits and reducing the barrier to entry for traders. Immediate liquidity. Spot markets generally offer higher liquidity, allowing traders to enter and exit positions quickly at desired prices, without the risk of illiquidity associated with futures contracts. Thank you for watching our exploration of spot trading versus futures trading in cryptocurrency. If you found this video helpful, please like, subscribe, and share your thoughts in the comments below. Your feedback is invaluable. Stay tuned for more informative content. Happy trading!